The S&P 500 has notched the longest run of weekly gains since The S&P 500 has notched the longest run of weekly gains since 2017, even larger and longer than 2021. At the same time, the fund that the Fed set up to basically bail out the banks, the Bank Term Funding Program, just seen its largest weekly increase in a very long time. This means there is stress in the banking system yet again. Or what about the fact the S&P 500 over the past 3 days has seen this aggressive intraday sell-off or end of the day sell-off, but yet markets just trend higher? This is certainly a sign of something, right? Well, here in this video, we're going to break all of this down. The good, the bad, the everything between. Put into context what's happening in our markets and maybe what the most responsible thing could be to do if you are an investor in our markets right now. Obviously, keep in mind, I am not a financial advisor, although we called this rally perfectly following the cup and handle breakout. I don't know what's going to happen definitively, but I have a pretty good idea. I would also love your opinions down below in the comment section. We will also talk about here in this video the implications for Tesla. If this happens, this will happen to Tesla. Or if that happens, this could happen to Tesla. And I think you guys will also find that very insightful. I will share with you what I am doing right here and right now in our markets and with Tesla. So let's go ahead and break down all of this information. If you guys want to come join the action firsthand, come ask me questions or anyone else in the trading community questions, check that out. Link down below in the description of this video. No matter what happens, whether markets go up, down, sideways, spin in circles, it does not matter. You can be set up to make a profit during any market environment. But on with that, let's get into all of this information. So let's start with this. I reposted this to the X account. So a lot of what we talk about here in these videos, I share it on X. So if you guys want to see it, most of what we talk about firsthand before a video is made, which honestly can help you make a lot of money, check out the Twitter account. It's Michael Tyler, very easy to find. Give that thing a follow. This says, oops, a bank liquidity indicator sounds the alarm. Emergency loans from the Fed's BTFP facility keeps rising. Rose another 7.6 billion week on week to 131.3 billion, a new high. Now, essentially what this is if you bought bonds at lower yields, that means higher prices. Now bonds are substantially lower. If you are seeing a lot of withdrawals to your bank, whether it is people taking their money out, whether just for spending purposes, or whether it is people taking their money out of their bank account to put that into stocks, which I think is actually pretty plausible to explain this, well, you can basically get the face value of your bonds at the price you bought them for instead of waiting for maturity. So in a perfect world, this is not going to cost the taxpayer any money. It's just the Fed saying, hey, your asset is worth this much right now, but it will be worth this much, a larger amount, in 2 years, 5 years, 10 years, 20 years, 30 years when the bond matures. We'll give you the face value right now because we're going to get all of our money back once the bonds mature. Sounds more complicated than it actually is. If you understand bonds, that made perfect sense. But this is a problem because it's not like the first avenue you would go down if you are a bank. Now, I don't necessarily think another banking crisis is coming, but it does show some weakness in the banking sector nonetheless, which is probably not the greatest for our markets. Now, this could be quite alarming as well. Kathy Wood of ARK believes deflation is likely in the coming year, expects aggressive interest rate cuts by the Fed. This was said during a CNBC interview. Now, deflation sounds great, after we have seen CPI at 9%, real inflation likely 30+% for a lot of your households and your personal finances. Everything is way more expensive than it was, call it back in 2020. Real inflation has been very high. Deflation sounds great, but in the economy, it's not so great. Imagine it like this. Deflation, it feels good to your pockets when it happens. The price of gas goes down, great. The price of toilet paper goes down, great. Who wouldn't love that? Well, the company that makes toilet paper or the company that produces your gasoline. If you break this down a little bit deeper, think about a Roku TV. Maybe that's on sale for $50 less. Well, those companies taking in less dollars means they're definitely not going to be hiring as much as they otherwise would have been, but they actually might start laying people off. So deflation might not be a great thing. You could make an argument that the reason the economy is so strong, or specifically the labor market is so strong, is because consumers have been spending during this inflationary period. And the amount of money companies are taking in is at record highs. So employment is at record highs. If companies start to see weaker earnings, less money flowing in, they're going to start laying people off. That's like what we've seen with Nike. Right? They're bringing in less money. They're not forecasting the economy is going to be great. The consumer is going to be in a fantastic place in the first half of 2024. So they're laying people off. At some point, deflation turns into a negative thing for the economy. That's what we want to be watching, because right now we're already running under the Fed's 2% target for PCE. New Edge Wealth says, quote, "The euphoria in the bond market has been largely based on the deflators' 6-month annualized rates that now look like they could be undershooting the Fed's target in the next few months." This is for core PCE, 6-month annualized. And I mean, man, this is kind of a scary looking chart. Core PCE 6-month, it's basically going straight down from 7% down to about 2.6% or so right now. If you look at core PCE food items excluded, 6-month annualized, you're almost negative. You're less than 1% currently. So this is great until you actually go under zero. Until you're negative, this is okay. But once you go negative, that might shift companies' perspective and say, if we have to lower prices to spur sales, we probably are going to start laying people off. Pantheon Macro also says it's tempting just to say these PCE data are all consistent with the soft landing story. But if the recent inflation trends continue as we expect, the Fed likely will face the risk of an inflation undershoot by late next or early 2025. And here's a similar chart. PCE core goods deflator year over year is almost negative, which that's not too crazy just because, I mean, you were negative in 2019 and 2020, but you're almost to that point. Keep in mind, the yield curve, in which everyone says this is the for sure telltale sign we're heading into recession, went negative in 2019. We ended up getting the Rona, right, in early 2020. Without the Rona, I mean, would we still have seen a recession? It was going down that road. So, I mean, if you look at this chart in the same way, that might not be seen as such a positive. Renaissance Macro Research reiterates basically the same thing. Core PC inflation is up 1.87% at an annual rate over the last 6 months as of November. Between used car and truck prices and housing rents, there is room for inflation to remain benign. We continue to see the Fed cutting its policy rate in March. The Buffett indicator suggests markets are overvalued relative to GDP. They're approximately 44.17% or 1.4 standard deviations above the historical trend line. And here you can see that on a chart. You are at a higher ratio of stock market value compared to GDP than even the dot-com bubble. So what this basically is if we scroll up here, it's taking the total value of the US stock market at about $48.41 trillion and dividing that by annualized GDP, which is about $27.7 trillion. You come to 175%, which you would expect this to be positive. It's basically always going to be positive unless you go through some kind of Great Depression. But the higher, the more potentially overvalued markets are. Back in 2000, the US Buffett indicator ratio was 146. Today, it's 175. This does not mean much to me in and of itself, but if you do see deflation and you do see earnings start to fall, you're going to be in a very vulnerable position in 2024. Now, is that my expectation? Well, not exactly. There's a lot of historical stats out there that we've talked about in many different videos now that suggest the next 12 months will be a great time to be an investor. I personally think in small, mid-cap stocks, interest rate sensitive names. If you want to go bigger, market cap with this, I would look at a Tesla for relative safety as well. Tesla's relatively more safe than your small and mid-cap stocks. Could your small and mid-cap stocks maybe, double, triple, 4, 5x compared to a Tesla's 1 or 2x? Sure, but Tesla has a degree of safety. So if you're older or if you have a lot of money, then Tesla is the best opportunity that I can foresee for 2024. But there will be some form of correction or pullback here in our markets, and it seems like it could happen sooner rather than later. But that's really just anecdotal to sit here and say that the SPY is overbought. The SPY was at, the most overbought point you've seen since, early or mid 2020, back here when the RSI was 83. Just recently, the RSI on the SPY was about 82.5. And that was before last Wednesday's aggressive end of the day sell-off. This reset a lot of your RSI, your overbought indicators, but you're still overbought. On the RSI, you're still at about 72, technically 71.4, but we'll round up to 72. So you're still on the overbought side. And I think if you look at this on the 5-minute chart, and you see these intraday sell-offs, end of the day sell-offs, that is telling you something, guys. That is speaking to you. Listen to the money. Listen to the price action. This is saying, even though you're getting these sell-offs, stocks continue to rally. At some point here, likely in the near-term future, we will take a breather. This is telling me, at least, that people are bullish, but they're not unrealistic. They're saying at some point, the valuations matter. At some point, we still have to come to the reality that it's going to take quite a few months for the Fed to get down to a rate that justifies a lot of money coming into markets. I don't expect it's going to happen at one time. This is the great shift of capital that I've been talking about. $20 or so trillion of investable capital, not in stocks, will likely come back into stocks. At least a portion of that, maybe $3, $4, $5 trillion, somewhere in that range. And that will drastically help markets. But as of right now, you've ran a lot, maybe too far too quickly, and you are due for a pullback in some form. Now, here's where I differ with analysts like UBS that expect stocks could fall back to the October lows. UBS just came out with that report last week that stocks could fall back to about 410 on the SPY. I don't exactly think that's going to happen, but to see a pullback back to the 465 level, your prior all-time highs in, the beginning, really end of 2021. Could that be possible? Sure. Could you fall back to your July highs of around 455 on the SPY? Sure. That's also a pretty realistic expectation, at least in my view. That would actually be pretty healthy heading into the later parts of 2024 to get a much larger increase to relative stock valuations across the board. See, the SPY and QQQ, they're market weighted so heavily to the Magnificent Seven that if Magnificent Seven stocks fall, the index is going to fall. But you could have a rally for the rest, 98% of stocks out there, and it would do very little to the broader indexes. So what I'm saying here is really Magnificent Seven stocks are probably going to fall, and the rest of the markets are probably going to continue to rally. I'm very bullish on small, mid-cap stocks, interest rate sensitive names. I think they shot way too far to the downside. They have a lot more upside from here. A lot of this thesis is based on the amount of money that is on the sidelines of this market. But Magnificent Seven stocks that have carried the indexes to new all-time highs, well, that is going to take a breather. Apple is going to fall. Microsoft is going to fall. Google, Amazon, they are going to fall, in my personal opinion. But the rest of the markets might do just fine. Hence, 2024 is probably not the year for the index fund investor, although the data suggests it will be. I think this is the year for the stock picker, for small, mid-cap, interest rate sensitive names. Morgan Stanley's outgoing CEO, James Gorman, said financial markets will, quote, take off once investors are sure the Federal Reserve has finished raising rates, the Financial Times reported on Friday. And I think this is true as well. I wouldn't be surprised if the indexes did go higher from here. I would be surprised if we just don't see a pullback. Stocks don't go up in a straight line. But I really think your beaten down names, a PayPal, a Tesla, a Fubo, a SoFi, those are probably the names that are going to see a much higher percentage gain than your Magnificent Seven stocks. But again, back to the recession argument. I don't think there will be an actual recession. I think it's very politically motivated to not see a recession. You've only seen one president, and this was in 1913. His name was William Taft, that was reelected when a recession happened right before the reelection. You've never seen a president win a reelection during a recession besides William Taft, or a recession technically happening 2 years before a reelection. It's never happened before, and there's been plenty of presidents that have tried to get reelected during a recession, and it doesn't happen. People vote with their pocketbooks. So I think Fed funds rates would go to zero before we see a recession in 2024. That would be my personal view. But it's not a recession, again, that causes stocks to fall. It's recession fears. So if we start to get bad data, recession fears, stocks would fall like we're actually heading into a recession, in which I think we will avoid. But whether or not we get recession fears, that I think is the real argument that should be had. Good news is small and mid-cap stocks like Tesla, the stocks that I mentioned, PayPal, Fubo, SoFi, stocks of that nature, they've already been priced as if we're heading into a for sure recession for the past 12 months or longer. So I don't think those names would be hurt nearly as much as the broader index or Magnificent Seven stocks. Fundstrat's Tom Lee also seems to agree with Mark Newton. Mark Newton writes, IWM finally managed to achieve its long-awaited weekly close above prior peaks going back since spring of 2022. We've seen both absolute and relative breakouts versus SPX at this point. While gains shouldn't prove uninterrupted, we do finally have a window for small cap outperformance next year. And that you can see very clearly right here. Also, remember, Tom Lee believes the IWM, the ETF for the Russell 2000, could go up 50% next year. So, I mean, I tend to side with Tom Lee most of the time, and that's something I have to be in agreement with. And if small caps go up 50%, Tesla's probably going up 100% just because of the high quality nature that Tesla possesses. Markets are currently pricing in 6 rate cuts coming next year with 37.3% odds. The odds of 7 rate cuts and 8 rate cuts and 9 rate cuts have been increasing. Last week, the probability of 7 rate cuts was 21.3%. As of right now, it's 34.4%. So if you start to get even some slightly weaker data here, the markets are going to start pricing in a lot more rate cuts. And I think the markets are pricing in 6 rate cuts when the Fed said they're going to only cut rates 3 times because of some of these 6 3-month annualized PCE numbers. Very quickly, it's going to become clear to the Fed, probably by March, by the time we're getting the first rate cut, that inflation is probably going to fall under 2%. And that could even turn into a problem for the Fed. Thus, maybe we do start to get 50 basis point rate cuts instead of 25 basis point rate cuts, just to not over tighten on the economy. Now, in terms of Tesla, I think 2024 in its entirety, by this point next year, by the end of 2024, Tesla stock is going to be above $400 per share. Tesla stock is going to be at new all-time highs. That's my personal opinion. Tesla could be $500-600+ per share. That depends on what kind of news and catalyst we do get. If we actually do get the announcement of the $25,000 vehicle and rates are, let's say, 2% because inflation is going under 2% at an aggressive pace, maybe it's 1.5% by the end of 2024, then, I mean, you could make the argument Tesla could even be above $500-600 per share. Let's say margins improve. Let's say Tesla's bottom line exceeds analyst expectations and the PE multiple does increase to, let's say, 100. Simple math here. Let's say Tesla does $5 of EPS next year because Tesla's able to raise prices. Well, the Tesla demographic is really not affected by a slight recession or slight slowdown anyways. So even in a relatively bad scenario for the economy, maybe Tesla is still able to, raise prices or at least keep margins improving from here. Let's say Tesla's multiple is 100. Let's say Tesla does $5 of EPS next year. That's $500 per share for Tesla stock. You can run the numbers however you want, but you will come to roughly the same conclusion. Tesla stock at new all-time highs next year. That's how you fundamentally justify what I'm saying. In Tesla at all-time highs, it's all fundamentally justified as long as we do get a multiple increase, and I think we will, as Fed fund rates do fall probably to 2.5%, 3% by the end of 2024. But at some point between now and $500-600 per share, or $400+ per share, you will get a pullback of some form or another. Now, I don't know if Tesla will fall more than the indexes, just considering the weighting of Magnificent Seven stocks and the over allocation of capital in those names. It's plausible you get the indexes falling and Tesla stock trades sideways or even higher. That's plausible. Or Tesla could underperform the index like it typically does during sell-off-like moments. During a sell-off-like moment, I would expect Tesla to stay around the 240, 230 range. In a 5-10% correction, you could see Tesla stock fall back to about 220. But I really don't think, unless we get bad news for Tesla, you're going under that. And this is really a short-term kind of call. Now through the next 3 months or so. I think if we're going to get recession fears, it's probably going to be within the next 3 months or so. Probably by March, April, you're either going to have recession fears or you're not going to, right? You could actually make an argument the economy might accelerate in 2024 due to deflation, which will keep us out of a recession. Again, then the question becomes, do companies start to lay off people, and does that turn into the fuel for a recession? So yeah, the economy is definitely a deep, uncharted realm most of the time, but I think this makes a lot of logical sense. I think the downside for Tesla is quite limited here. Again, remember, record high interest rates for Tesla's business. Tesla's still putting up phenomenal numbers. You would have to see a moderate recession, in my personal opinion, to see Tesla have a worse 2024 than 2023. So I think all of this makes sense, but don't be blinded here. Markets have rallied so aggressively, so quickly, that you're probably going to see a pullback in the near-term future. But I don't think that turns into a full-on crash-like event like UBS or some other analysts are calling for. And any pullback from here in interest rate sensitive names, not SPY, not QQQ, in my opinion, IWM, Tesla, small mid-cap, quality names, any pullback there is a buying opportunity. I am staying away from SPY and QQQ with a 10-foot pole. Risk to reward just doesn't make a whole lot of sense to me. Let me know what you guys think down below in the comment section. Hit the like button as well as subscribe to the channel if you found value or this information insightful in any way, shape, or form. If you want to stay up to date with further videos, hit the notification bell as well. Maybe these videos help you make money. We're pretty accurate here on this channel. It seems like broader kind of predictions are not the most difficult thing if you give it enough time, right? It's pretty easy to see when stocks are going to fall, stocks are going to rally. Indexes look like they're going to fall. So we'll see. I could be wrong here. Let me know what you guys think down below in the comment section. If you guys want to come trade with us live in real time, come kill it over there with us. At least we have recently, couple $100 into thousands of dollars. I think last week, the last 2 weeks have net been like $7,000 or $8,000 worth of gains. So come check that out if you guys would like to. That's going to do it though. Enjoy the rest of your day. Merry Christmas, and I will see you in the next one.